Yes. I hope that you all can hear me. If any problem, you have to just put a message to the chat box. Good afternoon, everyone. First of all, I thought of sharing you the the broader picture of investment. The one aspect is subsidiary, so which is covered under consolidated financial statement, SLFRS 3 and SLFRS 1090. Then associate, we have covered it for associate, and really it's for joint venture. But I am just taking here associates. Then another investment is called joint arrangement, which is our topic today, joint arrangement. Now, when you look at the subsidiary, you talk about the control. The criteria of identifying subsidiary is control. You know the meaning of control, I think. Criteria of identifying an associate is significant influence. We have discussed that also in our previous lecture. Criteria for identifying joint arrangement is called joint arrangement. Uh, I'm sorry, it's not joint arrangement. I would say very clearly joint control. Sorry, sir. Yes, it has to be joint control. Okay, control. Joint control. I will explain the meaning of joint control later on, not now. Then share is 50, more than 50. You talk up, the story share acquisition. Here 20 plus, here equal contribution. Equally, parties are contributing. And here the acquisition method, we call full consolidation method, acquisition method. We discussed the equity method, and the accounting method depend on type. Depends on type. We will discuss the two types. One is joint venture, other one is joint operation. There are two types. We will discuss that. If it is joint venture, it's coming under the equity. So other investments coming under the financial instruments, SLFRS 9 and LKS 39, we have to account for. So this is the broader picture if you are going to invest in a particular business. Subsidiary, associate, joint arrangement, and other investment is covering under SLFRS 9 and LKS 39. Is it clear? Right. So here you will see one important words are joint arrangement. Under that, before that, that when we define the subsidiary, you define the control. Under associate, you define the significant influence. Even under here, there is a new concept called joint control, but I discussed this joint control a little bit in our previous lecture. Today, our session is focused on this part. Okay. Okay. The joint arrangement. Explain the nature of joint arrangement, the learning outcome, how to classify joint arrangement into joint venture and joint operations. As I told you, there are two types of joint arrangement. One is joint ventures, other one is joint operations. Explain the accounting undertaken by joint operation itself. We are not discussing accounting treatment for joint ventures because it's coming under the case. I think you can remember, joint ventures we are not going to discuss because it's covering under LKS 28 associate and joint ventures. Explain the accounting undertaken by joint operator. Prepare journal entries required by a joint operator. Recognize its shares of assets, liabilities, revenues, and expenses of the joint operation, and prepare the disclosure required in relation to joint operation. So those are the disclosure matters. Basically, what we are going to discuss under this session is how to account for joint operations. Then further, uh, some companies join together to seek a common goal. Contrasts are signed that require all companies in all specific projects to act together to agree on a major decision involving the activities undertaken. In certain projects, uh, we one aspect is the projects are more risky and we don't have enough resources. So thereby, what we do is we tend to really tend to gather. We tend to have form a different teams, different ventures, different joint arrangements for just to manage the risk or the technological requirements, maybe distribution requirements, maybe operational requirements, maybe marketing requirements. So thereby, joint arrangement is the concept of putting resources together, putting different resources together. I think I took one example in my previous lecture, the Lodestar, heavy tire manufacturing in Sri Lanka, Ginesen and the other company. So this Ginesen provides the technical know-how and the rubber and the raw material and the labor, and marketing is done by the Lodestar, the Solitaire and the Solitaire brand. So it's because of the one party is not having one capability, other party is having one capability, and that lack of resources. One party having the marketing capability but not having other resources. One party is having manufacturing capability but not having the other resources like marketing. Then what happen is people will get together and manage the operation jointly. They joint control the operation. Joint control operation meaning is that both parties agree for the decision making, not one party. We call it unanimous decision making. Okay, we'll discuss what it is. Companies join together for various reasons here to share cost. If the cost is very high to share, they may link to manage the risk involved in the project. If there is a high risk, so people join together and to manage the risk. To provide parties access to new technology or new markets. If you don't have the access to market, you may join with a new market access distributor. If you don't have the technology, suppose you are going to start a really car, car manufacturing, motor vehicle manufacturing. You may have the technical know how to manufacture engine and all that, but painting part is not your technology. So thereby, you may make arrangement with a painting company just to operate this particular business. I think you got it. Maybe new technology, maybe software, maybe manufacturing related technology, maybe distribution related technology, whatever. We don't know. Technology may depends on the context. So thereby, what I want to communicate to you is the reasons for arranging, these reasons for getting together. My word is putting different resources together. Example, share cost, risk involvement projects, managing the risk, and new technology, new market. You can write anything. There are three reasons given. Key features of joint arrangement is joint control. You have to understand what it is very clearly, joint control. Okay, we'll see what it is. The characteristic of joint arrangement. Characteristic of joint arrangement is joint arrangement arises where two or more entities have an arrangement between each other such that these entities have joint control of the arrangement. Two or more parties, not only the two. Maybe in a joint arrangement there are three parties, but equally they are sharing. That's the idea. No one is dominating in this team. Two or more entities have an arrangement between each other, the arrangement between each other such that these entities have joint control of the arrangement. Joint control. I think classic example is, think about your family, mother and parent. What they do? There are only two parties, mother and the parent, but they jointly control the home affairs. They jointly control the home affairs. The control is there, but jointly control. Not in subsidiary case, you can remember parent control the subsidiary. But in this case, the particular entity is not controlled by the one entity, but controlled by two. So thereby it's called jointly controlled, not one. I think you got my point. Okay. The term in arrangement describes an activity or an operation or a specific grouping of assets and liabilities which may or may not form a legal entity. Now we have to remember, when you talk about the joint arrangement, it is not necessary to be a legal entity. It may be a, for 1 or 2 year arrangement, joint arrangement, maybe 3 years, maybe 4 years, maybe a project, maybe a company. But what I want to communicate here, which may or may not form a legal entity, either legal entity or not a legal entity. So an activity or an operation, specific group of assets and liability, this is applicable for an activity or for a particular operation or particular group of assets and liability. This is a unique business operation. So thereby we can consider in a way as a project also. Joint arrangement has two main characteristics. The parties are bound by contractual arrangement. The two parties or the parties involved in this joint arrangement having an agreement. We call it contractual agreements. In a contractual agreement, the purpose, activity, duration of joint arrangement, how board members are appointed, how decisions are made, the capital and other contribution required by the party, how parties share assets and liabilities, revenue, expenses, and profit loss related to the joint arrangements. How they are sharing the agreement. It's like a partnership agreement. Sharing profit, the agreement. So thereby parties are bound by a contractual agreement. So there is a contractual agreement. If there is no contractual agreement among parties or between parties, it is not a joint arrangement. You have to understand very clearly. You should have a joint arrangement. Okay. The second characteristic is the contractual arrangement gives the parties joint control of the arrangement. Joint control. Just because of contractual arrangement, parties are getting the joint control. Two things in a joint arrangement. There should be a contractual arrangement, contractual agreement between or among the parties, the relevant parties, and the contractual agreement gives the parties joint control of the agreement. You see what is joint agreement, joint control. The contractually agreeing sharing of control. Now you are sharing the control. Sharing the control means what? Power, your power to right to get variable returns. Can you remember that we define the control? Now this control is sharing. The control is sharing. An arrangement which exists only when decisions about the relevant parties require the unanimous consents of the parties sharing control. If there are two parties jointly control, those two parties should agree. If there are three parties, those three parties should agree. That is called joint control. If the agreement says that, suppose there are three parties involved for a project. There are three parties involved for a project, and say they get together. But in the agreement, it says that 2/3 majority is enough to finalize the decision. Then it is not a joint control. It is not joint arrangement. What I am going to tell you is that all the parties involved in the joint arrangement should control jointly. That means unanimous consent of the parties sharing control is important. Okay, there are two characteristics of joint control. There exists contractual agreed sharing control. As I told you, it does not need to be explicit. It can be implied from the contractual terms. Not need to be explicit. Decisions about relevant activities require unanimous consent. The two things: unanimous consent and the sharing control agreement. Okay. Then we'll go to the next one. The classification of a joint arrangement. There are two types of joint arrangement: joint operation and joint venture. Joint operation is, you have to understand, an arrangement in which parties that have joint control have right to assets and obligation for the liabilities related to the arrangement. Here, you have to understand this very clear. If it is a joint operation, you have joint control. That is true, but you have right to the assets and obligations for liabilities relating to the arrangement. If there are, say, 100 rupees assets, if 100 rupees assets 50-50, then your sharing is 50-50. 50,000 for you, 50,000 is the other part. That's what I'm telling. Okay. These parties are called joint operators. Joint operation is called joint operators. We are going to account for these joint operators. Then joint operation, an arrangement in which parties that have joint control have, this is not joint operation. It has to be, I think it's a mistake again. This one has to be joint venture, no? Not the operation. It has to be venture. Joint venture. Okay. Joint venture. So joint venture means an arrangement in which parties that have joint control, in both cases you have to remember joint control. So if you read this very carefully, here also parties that have joint control, and here parties that have joint control. The difference is right to assets and obligation for the liabilities related to the arrangement under joint operation, but have right to the net assets of the arrangement. Net assets means the equity. You have the access to equity. Here your right to, right to the assets, you have right to the assets and obligation for liabilities of the joint arrangement. Here, net assets, your right to net assets of the arrangement. Is it clear? We call it joint venturers. But what we did was, we are not covering this part. We have covered in LKS 28. So we account for under equity method. Equity maker. Why? Because your right to net assets. Your right to net assets of the arrangements means your right to have the equity. equity investment you talk about. That's why we are not covering here. So thereby in this session, what we do is we will just look at basic accounts for joint operators. Judgment is required to classify the joint arrangement. Now the next point is whether your joint arrangement is joint venture or joint operations. You can't decide it's in a simple way. So it's a judgment. It depends on the context. There are certain criteria discussed in the standards. It is not a straightforward decision. You need to consider there are four matters: the structure of the arrangement, the legal form of the separate vehicle, the term of the contractual agreement, any other relevant facts and circumstances. The structure of the arrangement, legal form of separate vehicle, the term of the contractual arrangement, and the other circumstances. We will see a diagram just to understand this first. Structure of the arrangement, structure of the joint arrangement, not structure through a separate vehicle, structure through a separate vehicle. Separate vehicle means there is a separate legal body to do that particular operation. There's a separate body to do that particular operation. And here, structure through in separate vehicle. Here there is no structure through a separate vehicle. There is no particular legal body, and here there is a legal body. Even there is a legal body, we don't know whether it is a joint venture or joint operations. There are certain questions to be raised. Separate vehicle, term of the contractual agreement, relevant other factors and circumstances. Those are the matters we consider. If once we consider these matters, we can decide whether it's a joint venture or a joint operation. Is it clear? So what are the criteria of deciding whether it is a joint venture or joint operation? There are three criteria: separate vehicle, term and conditions of the contractual arrangement, relevant other facts and circumstances. Is it okay? Right. Further, when you do, you can discuss it further. Legal form of the separate vehicle, we raise a question: does the legal form of the separate vehicle gives the parties right to the assets and obligation for liabilities relating to the arrangement? If answer is yes, it's a joint operation. Legal form, there's a separate legal form. We ask whether the particular legal form will provide the opportunity for the operators to have the right for assets and obligation for liabilities. If the answer is yes, yes. Terms and conditions. Do the terms of the contractual arrangement specify that the parties have right to the assets and obligations for the liabilities relating to the arrangement? Specify the parties have right to the assets and obligation for the liabilities related to arrangement. Terms of the contractual arrangements, the agreements. Are there any conditions in the agreement stating that assets and liabilities, belongs to the particular operators? If the answer is yes, then the other factors, for example, its activities primary aim to provide the parties with an output. It depends on the parties on continuous basis of setting the liabilities relating to the activity conducted through the arrangement. Its activities primarily aim to provide the parties with an output. So you do the operation. Suppose you produce certain items and you do distribute it. 50% output to the A, 50% output to the B. Then it's a joint operation, because your output of the operation, joint arrangement, is to distribute. So thereby joint operation. If that is no, answer no. If these three criteria are not satisfied, no, it's a joint venture. Is it clear? Okay, right. Accounting for joint venture is different from a joint operations. In a joint venture, each venture has an interest in the investment in joint arrangement. The equity method is used. We have discussed it earlier. Accounting by joint operation itself, where the joint operation is not conducted via a separate structure, separate accounting record do not need to kept. However, to maintain accountability, expected a joint operation every month would require such record be maintained. It's like a partnership. If there is suppose a particular particular case, uh, say there are two parties, A and B, and you have a operation C. Now this is A limited, okay, B limited. You know, B limited means the registered company, and they have 50%, 50%, 50%. What does it says? So this C may be not a limited liability. It's maybe a just arrangement, just a project. A C can project එකක් වෙන්න පුළුවන්. So there you won't get any legal form. Project. That's what I'm telling you. Here, where a joint venture operation is not conducted, yeah, separate vehicle, separate record cannot be kept. If it is not a company, no need of keeping records. But to ensure the accountability, like partnership, like individual sole proprietorship, you may keep the accounts. That's the idea. Is it clear? Okay. When joint operation does not sell the output itself, there will be no profit or no loss to report. So here this diagram what says that cost item 1, cost item 2, cost item 3, the manufacturing process. Maybe raw material, maybe overheads, maybe wages. Once you mix all this, you get the WIP, work in progress. Work in progress convert into the inventory. This inventory you may distribute it to J1, joint operator 1 and joint operator 2. That is the idea of operations. Okay. A statement of financial joint operations, main financial statements. So you might have a financial statements, accounting by the joint operations. Refer illustrated 2.541. 2.41 is not with us, no? What is 2.1? I think I have to go back to the slides. 2.1 is not with me. 2.1 is the chapter. Is it? Yeah. This is in the chapter. I will upload the chapter also. 2.41 accounting by an unincorporated joint operations. Before that, I just wanted to share with you one example to understand what it is. Here, look at this. Assume an arrangement in which A and B each have 35% of voting rights in the arrangement. A has 35 rights and B have another 35 rights. With remaining 30% being widely dispersed. 35 they are 70%, 30 the 30% rest balances with others. Decision about relevant activities require approved by the majority of the voting power, voting rights. If there is now decisions about the relevant activities require approved by the majority of the voting rights. Majority of the voting rights. Then only you finalize the decision. If there is a contractual arrangement A and B, which specify that decision about the relevant activities of the arrangement require both A and B agreeing. If there is a contractual arrangement to jointly control, then A and B has to agree. Then A and B have joint control over the arrangement. Then only we call it joint control. No decision about relevant act can be made without the agreement of both A and B. No decisions can be finalized without consent of these two parties. That's the joint control meaning. In the absence of such agreement, suppose an agreement no entity has any form of control over the arrangement, has a decision can be made about the relevant activities if any combination either A, B or C agree to it. Any combination either ABO, ACO, BCO, CA. Either combination, then it is not a joint arrangement. A and B may be considered to have significant influence over the arrangement, but not joint control. What I'm trying to say is that now A has 35, B has 35, other parties have 30%. Say C, A, B, C. A has 35, B has 35, C has 30. If the agreement says that when finalizing decision, 2/3 is required. 2/3 means 2/2. Then it is not a joint arrangement, joint control. A has a significant influence, B has a significant influence, even C has the significant influence. Associate. So associate when I even check. Is it clear? Right. We'll go to the example 2.5, 2.41. 2.41 is the little bit now here. 1st July 2015, X Limited, Y Limited signed an agreement to form a joint operation to manufacture a product called plasboard. They are producing plasboard. That is the operation. Operation is to produce plasboard. Who are the joint operators? X and the Y. This product is used in packaging industry and has advantages of strength and protection qualities of cardboard as well as flexibility and durability of plastic. That is the nature of the product. To commence the operation, both operators contributed 1.5 million cash. The X contributing 1.5 million, B contributing 1.5 million. They are not investing in shares. They just put money into this project. What is the project? Production of plasboard. In the example, it is assumed that not all raw materials used during the period and not all finished goods have been transferred to the operators. That means there are WIP and there are inventories of the operation. If that is the case, raw material, WIP, inventories are there the operation. Now you have to remember there are three units. One unit is X, other unit is Y, other unit is operation. Operation means the particular project of producing plasboard. That is called joint operation. So we have to keep the accounts of the joint operation. Otherwise, it's just for accountability. But we are not going to discuss in the standard. It does not you discuss how to keep accounts in the joint operation. It's similar to sole proprietorship. It is a, if it is a sole proprietorship, if it is a part, if it is a single operations, so normally cash, credit, debit, relevant assets, normal journal entries are passing. Okay, these are the journal entries recorded, journals entries recorded in the books. Contribution by cash by the operators, a cash account debit, the Y contributed and limited X committed credited. That is in the books of the joint operation, not the books in the Y and not the books in the X. These are the books recording journal entries in the books of the joint operation. Then they have used to buy equipment and raw material, use cash and loan to buy equipment and raw material. Then journal entry would be equipment gannakota, equipment debit, cash credit, and loan equipment. That means particular equipment has purchased for the operation, which is paid by 500 rupees in cash, and a loan amount is 300. Then they have purchased raw material on credit, 650, 650. Then wages, of course, wages management, 200, others, and all paid cash, but 20 rupees in not paid, like accrued wages. Borrowed from bank, you have borrowed 500,000 rupees from the bank and bank loan credit. Then loan equipment 100 and cash credit. That means the loan amount had settled. So it was a 300 rupee loan and that has been settled partly. Trade creditors so much and trade creditors settle part. 650 trade creditors here settle. Overhead expenses 1.3 cash credit. Depreciation is 880 and transfer of expenses to the work in progress. So work in progress account debit, the balance of the work in progress account, wages, raw material, overheads, and depreciations. So what happened is wages credit, debit the work in progress. Raw material credit, debit the work in progress. Likewise. Transfer from work in progress to inventory, inventory account debit, and work in progress credit. Then transfer of inventory to operators. That means the items produced has been distributed to two operators. Finished goods. So thereby inventory credit, X limited debit, Y limited debit. You can remember we open X limited account just like a capital account here. X limited contribution, Y limited contribution. It's like a partnership account, but we don't say capital, we call it contribution here. Okay, and you can prepare the cash book for the business. You know how to prepare the cash book. X introduced so much, Y introduced so much, we received so much for the bank loan, and we paid these expenses. These are similar to your cash book. There's no problem. But remember, all these entries not in the X and Y's book, but in the joint operations. And you can prepare the work in progress also. Here, debit, 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 all these expenses, cost, depreciation, inventory, so much. Ending balance is 780. Invent. This is the WIP closing. There is no opening WIP because we just started the operation. And finished goods being transferred so much, right? So you can prepare now the financial portion of the operations. Raw material 170, inventory 200, work in progress 780, cash 480. Cash 480 is the balance here, cash. And these are taken from the entries. 780 is the closing balance of the work in progress. Then you have equipment and we have depreciated it. You know the depreciation. Then trade creditors, accrued wages, and bank loans and loan equipments and total non-current liabilities. Remember, in the joint operation, we don't worry about the equity. In the joint operation, we don't worry about the equity. We worry about the assets and the liabilities, because we have the right for assets and we have the obligation for liabilities. So thereby, what is important is to have your assets and liabilities list. That is the important point. Then the statement of financial position, liabilities, net assets is so much. This net assets is really, 1500 introduced and 1500 introduced. And you can remember distribution, the worth of good, that much of worth of goods given to the operator 1 and operator 2. So thereby it is deducted, similar to drawing. Cost of the inventory distributed, cost of the inventory distributed, that is the total operation equity. Is it clear? Right. Then so example 24, contribution cash by a joint operator. When joint operators are contributing by cash 50%, the following information: extract the account, financial statement, joint operation, so much. Prepare the journal entries in the records of Sydney Limited and Melbourne Limited for the year ended 30th. Now you have to remember, this is for the 30th June statement of financial position for the above question, right? Now this is basically 24.2. That assume this has been really, given. Okay, given 1600. 1400. Okay, this is a new question. One for Sydney and Limited established joint operation, manufacture a product. Each company 50% interest operation, share output equally. Output is distributed equally. Two comments of the operation, both company contributed cash 1.5 million. 1st July 15, each operator depreciate equipment 10% on cost. So this is the financial statement of the joint operations. It's given. This data is given. Now prepare the journal entries to record Sydney Limited and Melbourne Limited for the year ended 30th June 2000. How to account for joint arrangement in the books of Sydney and in the books of Melbourne Limited. That is the question. So these informations related to joint arrangement operations, what we have to do? Very simple. In the joint operation, it says that equally, share output equally. So thereby cash 50-50, raw material 50-50, work in progress 50-50, inventory 50-50, equipment 50-50. That is the meaning of right to the assets. Right to the assets. Then other one was obligation for liabilities. Then you take half of this, 50%, 50%, 50%, 50%. That is the idea. Only thing is, what we have to do is, when you keep the accounts, we will keep the accounts in such a manner, right? So these are the entries in the records of X Limited. X means here the Sydney and Melbourne. Sydney. It has to be not the X. It has to be Sydney. Cash in joint operation debit 1.5 million. Now we are keeping the accounts in the joint operators. We have to take this seriously. Debit the 1.5 million. and cash credit 1.5 million. The narration is contribution of the cash to joint operation. This is the in the books of Sydney. What would be the journal entry of the Melbourne then? Journal entry of the Melbourne also same. Cash in joint operation 1.5 million, cash credit 1. Same journal entry will be recorded in the books of the other joint operator. Right. Now what happened is the initial contribution is 1,500. You can remember the initial contribution. I think you can remember the initial contribution 1,500, and you can remember the inventory transfer 700. Inventory transfer 700. How do you get it? It is something like this. Now you will see the inventory analysis is this. WI wages so much, raw material so much, overhead expenses so much, 2,250. Cost of the inventory is 1,600. This is the total, production cost. From this production cost, work in progress is so much. The production cost is so much. Work in progress is so much. So thereby, this is the finished goods cost, inventory cost, not the raw material. Here the raw material is there. Now you mix these three items and you do the production. The production can be divided in two parts, finished goods and the WIP. Now WIP is so much, so thereby obviously this is the value of the inventory, finished goods. Are you clear? Finished goods. Finished goods. So if this is the finished goods, if you look at the balance sheet says the inventory is 200. Balance sheet says the inventory is 200. So what would be the amount distributed among operators? You produce this much of inventory, worth of inventory. In your balance sheet, in the business operation, you have 200 inventory. So thereby 1,600 minus 200, 1,400 has been distributed. Are you clear what I'm telling? 1,600 is the inventory, right? 200 is the balance sheet inventory. That means 1,400 has been distributed among the operators. So thereby equally operated 2 divided by 2, that is 700. එතකොට එක්කෙනෙකුට යවලා තියෙනවා තොක නිෂ්පාදනය කරගත ඔබ 700. That is the idea. Is it clear? ඒක තමයි මේ අපි මෙතන අපි what we do is that is what we calculate here. Inventory transferred 700, inventory transferred 700. So thereby your right to assets and obligation to liabilities net amount is 800. හස් 1500ක් දැම්ම business එකට 1500ක් දාලා business එකේ operation එක කරලා business එකෙන් ගත්තා ආය 700ක්. So your interest, your contribution to the business when the financial year end is 1,800. That is the method of recording joint operations. So ඒක එන හැටි තමයි මේ තියෙන්නේ. මේ භාග ගන්නවා. Here raw material 50, the half of the raw material, work in progress. Balance sheet එකේ තියෙන assets, these are assets in the balance sheet. WIP, inventory, equipment, all half you take. Inventory half and liabilities also half, 50-50. This is the portion of the first operator. The other 50% is the other operators in the books. And remember, this journal entry is very careful. Here the logic is 1,500 you introduce. The closing balance is 420. cash balance එක reconcile කරන්න එහෙම. මෙතන මේ cash balance එක 420. මේ the receipts payment. නේ cash balance is here 420. 420 එන්නේ receipt and payment එකේ difference එක. එතකොට ඒකෙන් භාගයක් අපිට IT ඒ භාගය අපි අඩු කරගන්න. So that is 1209. That is how you balance the journal entry. Okay. Then the contribution assets of a joint operation. You can contribute assets to the joint operation. Contribute assets to the joint operation. Earlier we contributed the money. Now you can contribute assets. Just look at this example. Yeah, this example. We'll ignore that one. Contribution of non-current assets by an operator. So not the cash, but the assets. Here, each company 50% interest of operation shares output equally. To commence operation on 1st July 2015, T Limited contributed 1.5 million and Heads Limited contributed equivalent which had a carrying amount of 1 million. That is the idea. Carrying amount of 1 million at fair value is 1.5 million. Head දෙන්නේ සල්ලි නෙවෙයි equipment. Just like a partnership, you can bring other assets also in addition to cash. Okay, then you can prepare the balance sheet. Here, the balance sheet, cash, raw material, working, the inventory, the balance sheet. So this is the balance sheet of the operation at a particular year, at a particular point. පටන් ගත්තේ 2015 12යි 2007 2015 7යි එක balance sheet එක තියෙන්නේ 2016 ජූනි. එතකොට operation එකේ business වෙලා ඒවැ result එක තමයි මේ තියෙන්නේ. මෙතන තියෙන සුවිශේෂ ලක්ෂණය තමයි contribution. When you prepare the cash book, you get only 1.5 million cash, not the other 1 million which was in equipment. ඒක සල්ලි නෙවෙයිනේ. When you look at this, the costing curve, you know wages, raw material, depreciation, overheads. Remember, depreciation we consider as the production cost. Production cost තියෙනකොට එතකොට inventory වලයි හැමතැනම ඒක තියෙනවා කියන එක. Prepare the journal entries for the records of the operators of the year-end 30. You have to prepare the journal entries for the operators. So these are the journal entries. So you introduce here T Limited introduce 1.5 million. Half of that you take. And equipment, half of that. You have to remember here. Now in this case, little different from the previous case. What I am telling you is that they put 1,500. That is, I would say, in rupees, 1.5 million. This is cash, right? That was contributed by T, and H contributed again 1,500. That is true. But this is not in cash. This is, I think, one particular assets, maybe equipment. I can't remember what it is. Equipment. Now what I am trying to say is that once you put this, you have to remember that is the joint operation capital. Agree? Once you put that into the joint operation, we don't raise the question who put that. Operators jointly control these assets. Operators jointly control these assets. 1.5 cash and 1.5 million equipment. So thereby, in the joint arrangement, for these assets, I have the right as the operator. T has the right. T has the right. T has the right. Not only the T, H also has the right. T has the right for assets and H has the right for assets. You got my point? How? How many? 50%, half. Divide by 2. You divide this by 2. That's why here this you divide it by 2. Okay? The journal entry would be in the books of the T's books. Cash you debit 750, which is called joint operation. That's the initial journal entry. Joint operation. Equipment in joint operation is 750. That's the opening journal entry. Beginning journal entry. And cash, you are giving cash to the operation 1.5 million. Here, මේ cash ටික තමන්ගෙන් එළියට යනවා. ඒ එළියට යන එක තමයි මේ තියෙන්නේ. Is it clear? That is the open journal entry. So this is for really the heading is you have to remember contribution of non-current assets by an operator. Non-current assets by an operator. Okay. Then of course, based on your balance sheet, you prepare all the entries, debit this account and credit, debit all the assets accounts and credit all liabilities account, but half percentage, 50%, but cash in joint operation would be not like that. Cash would be, cash you credit 540. 540, how do you get the 540? You put cash 750, that is true. You put cash 752, the half, not the full, because your opening cash in joint operation is 750. That is the opening balance, 750. Is it clear? Opening cash in joint operation 750. How next the closing cash of the joint operation? What would be the joint operation closing cash book? 2,500 minus 2,080, that is 420, which is appeared in the balance sheet here, 420. So from this 420, it is an asset which is 50% for you. That's why we are taking 50% and we reduce it from that. So your net ownership would be 540. Because this asset is there in the books. So you take 50% and here you take 70%. You credit 540. That is the idea. You credit 540. Okay. But in the books of Heads Limited, you put the same entry. Remember, in the books of H Limited, you put the same entry, but there is a little bit change in journal entry. You get cash 750 because you are jointly controlling, and you have to remember, you record this as not 1.5 million. Even though you transfer it at 1.5 million, you record this as 100. The books it says 100. 100 means 1 million. So you take half of that. And you credit the equipment account, you remove the carrying amount of equipment in the books of the H because you are transferring it to a new operation, and there you are gaining a 500,000 gain, but your gain is half 250. That's how the double entry. 750 debit, cash in joint operation, equipment joint in operation 500, equipment 1 million, and gain on sales of equipment 250. So then half of half, same thing, you continue, same journal entry. From the balance sheet, you take half, 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 liabilities half, half. But remember, here 750 you take minus 420. Is it clear? All right. Now there's a small adjustment. Remember, we consider here the, depreciation as per 1 million, not as 1.5 million. Here the depreciation is based on here 10% depreciation means for 1.5 million depreciation. So thereby there is a depreciation impact which is 25 rupees. 25 rupees depreciation. Here depreciation recognized by T Limited 75, which is based on the fair value of the assets. However, the equipment in the joint operation has been recognized 500, which half of the original 50. So I will explain this again. Now, initially the carrying amount of the equipment which was introduced is 1 million. But we transfer this as 1.5 million for the operation. So you take half of this. Half of this is 75. No, 750. Here 500. If depreciation is 10% as per the question, here the depreciation is 50. Here the depreciation is 75. This is the based on transfer value. This is based on the carrying amount. So thereby what this says is here depreciation 75, here 50. The difference is 25. That's the 25 here. So what you have to do is you have to make an adjustment for this 25 in the books of the provider in the books of the provider. Who is the provider? The H Limited. Here what you do is, depreciation is being charged to the production cost. Here depreciation is charged in the production cost. Here wages, raw material, depreciation, other overheads, all these production costs. So thereby what you have to do is you have to make the adjustment in the inventory. Here inventory in JO, inventory in what do you call work in progress. That is how you get the 1200. So 1200 into 400, 1/3. 100 divided by 1200, $1. 700 divided by 1200. So 25000 මේකට proportionate කරලා මේ බෙදලා තියෙනවා. So then the entry would be equipment in JOI debit 25,000, debit 25,000, work in progress JO 800, inventory in JO, and inventory in inventory. So the entry records head limited to adjust the accumulated depreciation and the cost of inventory related account is that. So thereby what we have to do is the respective entries which was recorded here, work in progress, inventory reduced by the proportionately. Adueno. That is the idea. Okay, I think basically those are the two questions which I want to discuss with you. The same thing in the slides, and only thing is this question is a little different. So what you have to do is just try to do this 24.5, 24.1 in the chapter and the additional information in the slides. Same as per 24.2, same way. Yeah, everything I will be uploaded. In fact, really, I was busy in the morning uh, with the preparation of this material and all that. I will upload slides and what do you call lecture notes, chapter, and the recording. Everything I will be uploaded. Don't worry. But just now I will upload two chapters and the slide presentation. What I am asking you is to just read the chapter and get it understand. We'll see. Any question? I know this very difficult to understand, but you have to live with this context. Then only you can understand. If you read the chapter from beginning to end, I hope that you can understand. There is no big thing here under joint operator accounting matters. It's more similar to take 50%. More similar to take 50%, just like partnership account. Uh, you take 50%, but there are small adjustments. As I explained, suppose you contribute not cash, but some other equipment, and the equipment fair value is different from the carrying amount, then there are small adjustments. Any question? Okay, if no question, what I will do is I will finish. So Sandharwan sir will join with you in the next week for some revision. I don't know. So my part is over. Thank you very much for joining with me. See you all. Good luck. Take care.